One very underlooked and very important strategy in trading is the draw on liquidity. Now, the draw on liquidity is a very important concept that every trader must know in order to improve their trading gains. Okay, welcome back. This is Loan Academy, and on today's video, we'll be discussing draw on liquidity. Basically, the importance of draw on liquidity, the types of draw on liquidity, and how it can help improve your trading very significantly. Okay, so without wasting much time, please do well to like, subscribe, and share this video to people that you know that are struggling in your area and your circle. Thank you, and let's go straight into it. All right, so what is drawn liquidity? Drawn liquidity refers to how the market targets liquidity pools, typically the highs and lows and around key levels. Understanding key levels as a trader helps anticipate price movements and make informed decisions. Now, finding your key levels has to be one of the very first things you have to look for when taking any trade. It has to be one of the first things, your priorities in a particular trade. All right. So, what are the importance of drawing liquidity? As we already introduced the concept, I want to tell you how effectively it can be while you're trading. And from here, we can go to the technical aspects of where I'm going to be showing the charts and a couple of textbook diagrams as an example of how to spot and trade draw on liquidity. All right, so importance of draw on liquidity. Draw on liquidity helps traders anticipate price moves by identifying key levels where liquidity pools, such as swing highs, swing lows, accumulation, where these liquidity pools occur. Now, these levels often act as magnets for price and recognizing them improves trade timing and risk management. Draw on liquidity also reveals where institutional traders might step in, allowing retail traders such as you and I to align with smart money. Additionally, knowing where liquidity is drawn helps avoid common traps like stop hunts and avoid unnecessary setups. Okay, so having known the importance now, what are the types of draw on liquidity? We have the long-term draw on liquidity, which I'll be showing the textbook diagram here. But first of all, get the concept of this now. Short-term draw on liquidity basically signifies um where retracement profiles or shorter moves could end. It is used to determine where the market is initially drawn to in the immediate price action. It can also be used to determine your stop loss while taking any trade. Okay, and then the long-term drawn liquidity, which is the one down here, is about major moves. Okay, it helps look for or identify where the market is going to expand to. Major moves and expansions. It helps you see where price is heading to in the bigger picture beyond immediate market reactions. Now, this is used for understanding where price is likely to go as part of a broader narrative, guiding larger moves over higher time frames like daily time frame, weekly time frame, or even monthly time frame. Okay, so just to explain this now, I have a textbook diagram here of a bullish trade or bullish trend, and then we have a sweep right above here, and then a retracement. So this basically now, if you look clearly, you can see this the markups of short-term drawn liquidity and long-term drawn liquidity. Same thing for this bearish trade that has a sweep here and also reverses to the buy side where there is a short-term liquidity and long-term liquidity. Okay, so one basic thing, one important thing in identifying drawn liquidities is knowing your order flow. Order flow, I have said it before and cannot be overemphasized. You need to know where the market is going at any given time in order to find a very good setup. Okay, so what are the order flows we have? You know, we have the uptrend. You can also call it market structure. You know, we have the uptrend, and you know, we have the downtrend, and you also know we have a ranging market or consolidation. Okay, so these now are the three basic types of order flow you can find in the market: the uptrend, the downtrend, and the ranging market. Now, understanding order flow now helps us to determine the draw on liquidity. It can help us to determine where we are where we have our short-term drawn liquidity or where we have our long-term drawn liquidity, basically through the break of highs and lows that you can find. Okay, so drawn liquidity can also be found on as a couple of concepts or strategies, which probably in the next video I would want to chip in that one so as to tell you what exactly you might see on the charts and then how you can identify them. Okay, so let's now go straight into this textbook diagram now. So let's say for example we have a key level at this point. Since this is a buy trade, we have a key level at this point. Okay, and this key level here is actually above. Okay, there was a fair value gap around here, or there was a mitigation block around here, whichever way it might be, and then you have your entry right above here. Okay, let me not confuse you. I'm not confused with them patterns or charts now. Let's say now that we have these as a daily time frame of our candle, daily candle of our candle, and you come to the chart and then you see a previous high that was right above here, and eventually what the market did was come to take out that high with a wick and started reversing. Now during this reverse now, there are two significant things that can happen in this particular trade. Firstly is the market is looking to push down, take out this long-term drawn liquidity, then continue in a bearish movement, then continue in a move like this, basically using here as our key level, because you get it now, when there is a sweep of the high and a retracement, basically the market is wanting to change direction. So probably now it takes out this high, then gives a retracement into this key level and a continuation. Okay, this is one way you can spot long-term drawn liquidity, basically taking this area now as our take profit. I mean this long-term drawn liquidity, basically taking it as our take profit and setting our stop loss slightly above. I'll still show you this in the real life charts if it's getting confusing for you, so just stick around and when we get to the charts you understand it very well. Same thing happens for a sell trade here, a sell market. This is a sell and eventually market sweeps this last low and starts retracing. Retracing in the sense that it doesn't come back down to continue here on the long term, on the short term drawn liquidity, rather it sweeps it out and there is a retracement right above here. So basically what we might be looking at is once it breaks this high, eventually we've already known that yes, the market has changed direction. And the only thing we'll be looking at now is a key level to continue our buy trades. And this now will serve as a very good key level because this is the last candle that started the retracement. So he eventually does this, taps and eventually continues in that same direction. So this now has shown us our um, long-term drawn liquidity where we can target, and then our short-term drawn liquidity where we can set our stop losses. So in order to show this very well, let me quickly just do a markup. So we have this and we set our stop loss slightly above the sweep of the short-term liquidity and take profit on the long-term liquidity, and then wait for the market eventually comes, taps into and moves. Same thing happens for our bullish to bearish. Set a stop loss slightly below and then target above. All right, so this now is significant example of textbook diagram of short-term and long-term drawn liquidity. Now coming here now, we can actually see a very good example of this now, which I just signified, which I just explained here. Here is our bullish trade. Eventually we had this move, and at this point market did not quite take out this place, rather it swept a key level. You know, inside here, this is just a high time frame structure textbook diagram, but you know inside here there are a bit of substructural diagrams here, and there was a liquidity sweep here. Let's say this, for example, market comes and sweeps it out, causes a dragonfly doji candle here, which if you see on a key level, you already know it's a change of character. It's going to be a massive pull or expansion to the opposite direction. So you find this, and then you find an eventual continuation from a key level right above here, and then you drop an expansion into the change of character. So basically, when you see this now, basically we'll be looking for continuations for sell. Then you continue your sell movement. All right. So I hope you've understood this particular concept, because we'll now be going into a textbook diagram. We'll now be going into the charts now in order for you to see very, very well how this draw on liquidity occurs. So to recap, pardon me, to recap, let's redraw another one. Okay, sorry, let me still reuse this one so as not to waste time. So we have this move and that move, which is for the bearish and the bullish. And there is also a particular example you can find. Let me copy this. You can also find this as an example where you see an eventual downtrend and the market does this move now. Okay, let's say it doesn't sweep this particular zone. Instead, it continues. Instead, it continues the move. Okay. When you see this now, eventually what it's trying to say is this zone now has not been violated. Reason why it has not been violated is because market closed below the zone, basically showing us that yes, market is still in motion of the downtrend. So if this happens now, this remains our short-term drawn liquidity. Okay. When this happens, this remains our short-term drawn liquidity, and this remains our long-term drawn liquidity, basically targeting this place now as the long-term drawn liquidity or the take profit. Okay, so when this happens now, you know eventually that yes, market is still in session, it's still in the same trend, and we're not looking for any change of trend, and you continue into this zone. So let's say now you find this, and eventually the market does something like this. Okay, the market does something like this, and then sweeps this place. Once you see a sweep, a weak sweep, then you already know that yes, it's still in motion, it's still in trend. Okay, get this right now. Get this right. We have, let me copy this. We have from here, and market comes back to do something like this. To do something like this, and gives us a weak sweep. That's this now. Once it takes out this high, you already know that yes, this is our short-term drawn liquidity. There is no change of character, and we are going to continue in the same direction, which is the trend line. Basically, there was no break below here of the green candle. It was just a sweep, and there was no also body break above here. Every other thing that happens here happens in the same downtrend movement. Okay, but eventually when you find out that there is a break above, there is a break above this area now, that's when you now start looking for a change of character or a reversal. All right, so thank you for understanding this particular concept, and now let's go into the charts in order for you to get this very correctly. So this was for the reversal of the bearish, and this is for the reversal of the bullish. I hope you've understood this concept. And getting down to the charts, this is our daily time frame. Sorry. This is our daily time frame. Okay, let's stay here. And on daily time frame, overall, the market structure is bullish. Okay, it's on a buy overall. But then in between now, we can find something. Firstly, there was a counter trade down here. That's a sell. So watch this now. This is our short-term drawn liquidity. Let me zoom this more. So this is our short-term drawn liquidity. Why did I say it's our short-term drawn liquidity? You can see that there was a sweep by a week of this previous high. So this now is our short-term drawn liquidity. If there was a body close, they will know that yes, market is still in session, it's in continuation, and eventually will still continue in a buy trend and then look for short-term below. But now you can find out that markets broke this high. Markets swept this high by a week, making this a short-term drawn liquidity, and then close below this area now, close below here, basically making this zone our long-term drawn liquidity. So this area now has signified for us that yes, market has changed and we're now on a downtrend. So let me articulate this now. This is a long-term DOL, and this is short-term drawn liquidity. And I believe we know why. Okay, so continuing now, this has already told us that yes, we are on a downtrend, and eventually this is going to be a key level for continuation of price. Maybe this is on a daily time frame. When price comes back here, you know that yes, there will be a continuation, or even if it doesn't come back here, there is a fair value gap right in between here. So yes, we can actually take this fair value gap as an entry for continuation. All right, so even if you look at the fair value gap now, watch this now. Market has actually mitigated this zone, the fair value gap zone. Let me use this and then reduce. Okay, so this is our daily fair value gap. The market came back to retest into it and continued in a sell position. So when we go down to 4 hours or 1 hour time frame, you actually see exactly what's happening inside here. But for now, just understand the concepts that we're trying to paint, understand the picture I'm trying to paint here. So yes, this is short-term drawn liquidity, long-term drawn liquidity, and eventually there was a continuation. If you even look at here, there was also a candle here that is going to be swept furthermore. Okay, going down now, you can find out that yes, the market created this high right here, and then market swept it also, giving us a strong impression that yes, we are still on a downtrend. Okay, after this sweep, and continuing now, market just continues to take out the lows, take out this low also, take out this low also. All right, so this is now the textbook diagram of our drawn liquidity. Now going down to 4 hour time frame in order to spot on and know how to set our stop losses and take profits. Okay, going down to 4 hour time frame, this is what we're finding. Still on the 4 hour time frame, there was a sweep here, no debate about it, and this is the low that the market broke on below, and this is the week the market might come back to sweep right about here. Okay, continuing now, you'll find out that there are liquidity zones right here. Market swept the whole liquidity here, took out this zone, took out this fair value gap also that is in between here, this fair value gap, or this fair value gap now, and then continued. And if you understood when we discussed fair value gap, if you don't understand, if you don't know what fair value gap is, you can basically go to the previous video and watch it. Okay, took out the fair value gap, tapped into the 50%, which is consequent encroachment of this fair value gap, and continued in a downtrend. So if I am to take an entry now, taking an entry from, okay, I like refining my entry, so basically I'm going to take my entry from 50% of the fair value gap. I refine my entry so that I can get a very minimal stop loss, so that I can risk lesser and then have more profits. That's why I refine my entries. So if you want to understand refinement of entry, there is a video on it also. Go and watch it and you see how I refine my entries and then get a very concise stop loss and a maximum profit. All right, so this is my refined entry, and basically where am I looking at to take my profit? The drawn liquidity. This is the previous low here. This is the external range, the low that was created. So this would be my long-term drawn liquidity. Long-term drawn liquidity. And eventually, as you can see, the market also came to sweep it with a wick. All right, so this is a 7 hour trade, and it was a very smooth trade. So let's say you leveraged $100, for example, on this particular trade, and it doubles by 7. You know you already have $700 with a good risk or a good leverage. All right, so this exactly is how you identify your draw on liquidity. Remember, we started from the external range and then we scaled in down into this particular zone and then got our entry. Now, many of the things that happened inside here is actually none of our business because this is a ranging market and everything that happened here is within this particular move. Okay, there was no significant higher time frame break of structure or change of character that can tell us that yes, that these moves are valid. So every other thing that happened here is in between this range. So we're not actually taking it into consideration. What we're looking at is what is going to happen on the higher time frame. So this now is a practical example and explanation of drawn liquidity. Thank you very much for watching. And remember, like, subscribe, and share to your friends. Please do also backtest this particular strategy. Backtesting is a very important aspect of every trade. Backtest it, find out the win rate, and find out how much losses you can take on this particular draw on liquidity and how much profits you can make. Thank you very much for watching, and see you in the next video.